Welcome to the Personal Pension Radio Podcast, where it's all about helping you complete your financial journey to retirement. Discover time-tested strategies and get unconventional insights into wealth building and retirement that actually work. Break away from the herd and go for the retirement you dream of. And now, here's your host, the income engineer, Kraig Strom.
All right, back on Personal Pension Radio. Excited about this episode. I am in one of those ranting moods. So here we go. I am the income engineer. My specialty as a certified financial planner professional is the conversation about income planning. That's right. All of this retirement savings that we do and all of the talk about investments and all the talk about allocations and diversifications, well, all of it really truly someday boils down to what? We want income from all that work someday so that we can stop working at our work job, right? The whole idea is to head towards an income that can sustain a lifestyle that we might actually look forward to, that we might actually be able to enjoy. And that's the part that's missing from the typical Wall Street only retirement conversation, is this idea that income economics are extremely different from saving for retirement. I had that conversation just this week. Once again, talking with someone who is actually a listener of this show and just reminding them that the economics of retirement income are a completely different conversation than if we're in a mode where we are saving for retirement and save for retirement. Very different. It's important that you have to connect the two, and that is my specialty. My mission is to deliver that retirement conversation that connects the dots. If you think about it like a mountain climbing journey, that the true goal of climbing a mountain is not to get to the top, it is to get back down the mountain. That's the goal. And if you look at it in the retirement economics perspective, up the mountain is save, invest, grow. Down the mountain is that income side of the journey. You've got to be able to pack your bags for that journey so that when you get to the top of the mountain and decide that it's time to stop working in your regular job, if you're going to officially retire, how are you going to draw income with a strategy that will actually make sure you don't run out of money and draw income at a lifestyle rate that you might look forward to? That's the key. You want to actually look forward to it. And so often I hear people tell me nowadays that the retirement income numbers that a typical Wall Street only investment person puts towards them is they're just depressing. They're very depressing because an investment only, Wall Street only, mainstream approach to retirement income is often a very disappointing conversation. So my mission is to change that for you. If you would like a personal review of your current retirement income path, send me an email, Kraig with a K, Kraig at kraigstrom, strom.com. And I would be happy to virtually meet with you, or if you're right in my neighborhood, we'll meet together in person. But I meet with folks all over the country through the miracles of technology. Now, I do want to jump in today because I've got a lot. So, my disclosure, the short form disclosure before I forget, because I am a real, you'll hear me say that today a couple of times, I'm actually a real certified financial planning professional. I am not an attorney. I am not a certified public accountant. I am a CFP. As qualified as I might be, as I might think I am, as I hope you know I am, please don't act on things that you hear on my show as if you're hearing advice for yourself. And you'll hear it today in my rant. Please don't act on things that you hear from financial entertainers. Financial entertainers are people who are not licensed as financial planners. They have no business truly giving out financial advice on the radio, podcast, or anywhere else. They really just simply operate under free speech, and they say whatever the heck they want with no oversight, no regulation whatsoever. Please don't act on things that you hear from financial entertainers as if you're hearing advice for you specifically. Meet with a qualified financial planner first, and I would love that person to be me. Or if you want to meet with several, include me on the list, Kraig with a K, at kraigstrom.com. All right, now, a quick shout out to a listener, Bill from North Carolina, for today's Watch Your Step segment. Thank you so much. I really appreciate this. It did get my blood boiling as I was preparing for this. So jumping into the first segment, Watch Your Step. Last week, just as a reminder, we talked about this article in Financial Planning Magazine that I get as a financial planner. It was about maximum income. And it was about maximum income, and I thought maybe it might actually have some information in there like, finally, they're going to talk about, this is going to be good. Nah, it wasn't. I got to tell you, go back and listen to that episode about the maximum income article and the information in Financial Planning Magazine so you understand what we're up against here. What we, you, the listener, and me, the financial planner, what we're up against when it comes to this retirement income conversation. There is so much missing from the mainstream investment and financial advisory retirement income conversation. It just, it frustrates, but I've got to bring it to your attention so that you can be aware of it, so that you can be asking the right questions. So now, Bill from North Carolina, he listens to my show. Thank you so much, Bill, on the way home from work or the way to work, either way. But he was listening to Dave Ramsey's show on his drive to work. And by the way, love it. I listen to Dave Ramsey more than most people, because I just want to hear what he's saying and sometimes what crazy things that he's saying. Yes, it does make my blood boil, but he is the guy with the big microphone, so I'd love to hear what he's talking about. Well, Bill from North Carolina was actually listening to the show, and he heard Dave Ramsey tell a caller that the only type of annuity that they recommend, they being his firm, his company, his advisor partners, etc., the only type of annuity they recommend is a non-guaranteed investment type annuity. What the heck are you talking about? Okay. I have heard Dave Ramsey for years, routinely, basically the way he comes across, that annuities in general are terrible. Basically anything but term life insurance from a life insurance company is horrible. Anything from a life insurance company, if it's not term life insurance, according to Dave Ramsey and the way that he has generally been, this is just his outward in both in writing and on his radio and podcast, basically saying anything but term life insurance is horrible, and anybody selling it to you is, a spawn of Satan. I mean, I'm serious. That's just the way he comes across, right? And here I have a listener of my show saying that he's actually saying that an investment type annuity is the only type of annuity he would ever endorse. What in the... I was smoked. I could not believe it. So I looked up the episode and found the transcripts. Sure enough, he says this, and now I do have to change it. I'll explain here in just a moment. He says this, quote, "The only type of annuity we recommend is an investment type annuity." For the record, okay, I cannot invoke the actual name of the product due to the regulations that I live under as a real financial planner. I've changed the words because I cannot actually say that without heightened scrutiny on my show. That's because I'm an actual, real, licensed financial planner. Okay? Basically, here's the thing. He goes on in the transcript to say to this caller, there are two types of annuities. Fixed annuities are basically a savings account at CD rates with your insurance company. Dumb, dumb, dumb. Never do that. Hear me, folks. fixed annuities are basically a savings account at CD rates? Really? That is such a load of crap. That is an absolute load of crap. I do not know any time in 20 years that I can remember, and I'm sure I could go back and talk to advisors with 30 and 40 years. I cannot remember any time when fixed annuities were at CD rates. No way. That doesn't happen. And especially today, fixed annuities are substantially higher interest rates than bank CD rates. Now, that's not the issue. The issue is that his flat out statement is, they're dumb, 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 never do that. Wow. So you're saying that Dave Ramsey is saying that I should go talk to my mom, okay? My mom, the income engineer's mom, and I should say, hey, Mom, you know those guaranteed annuities that we used to take care of you financially after Dad died? You know, the ones that protected all your money from any losses, and you earned a really good basic guaranteed rate of return. Oh, and those annuities that we turned into a guaranteed income stream that no Wall Street account could ever replicate or secure any kind of a long-term guarantee like your annuities. You should never do those. Of course not. Fixed annuities done right and used correctly are a fantastic tool. They really are fantastic. This idea that it's just, again, fixed annuities are dumb, dumb, dumb. Oh my gosh, that just drives me nuts. Now, here's the thing. Dave Ramsey went on to say this. Right after he says fixed annuities are dumb, 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 he says non-guaranteed risk annuities with investments inside instead of fixed guaranteed rates, right? Those are the only ones that we would ever actually endorse. What? I'm calling it out right now, today, on my little podcast. Dave Ramsey is a shill for Wall Street. He is an absolute shill for Wall Street. He slams guaranteed annuities and promotes investment annuities. Why? Why would he do that? He is so many times on his show and in his books, he has said that, these things from life insurance companies, they just pay big fat commissions and anybody who sells them is a terrible person, right? And here he is basically saying, the non-guaranteed annuities, those are the only ones to recommend. Well, I'm here to tell you, okay, I personally have not been able to figure out why and when I would recommend once or twice in 20 years, once or twice, I've had an opportunity where a non-guaranteed annuity with investments inside, it looked like it was going to make sense. It didn't ultimately be end up as the direction I went. But one of the big things, the biggest thing that I have an issue with the non-guaranteed annuities is the cost, the fees, right? The fees inside a non-guaranteed investment type annuity, they're just, in my opinion, they're just too high. They really are too high. They have some really important benefits that I'm not going to go into here, but this idea that Dave Ramsey is just flat out saying that guaranteed annuities are dumb, 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 and investment type annuities, those are the only ones that I would ever endorse. He is a shill for Wall Street. That's it. Think about this. He slams guaranteed annuities, right? Well, guaranteed annuities, by their nature, take money out of a Wall Street environment and puts it in the life insurance company environment where Wall Street is no longer making a fee on it. Investment advisors are no longer making a fee on a guaranteed annuity, right? Wall Street doesn't like anything that takes money out of Wall Street. A non-guaranteed annuity has investments inside. That sounds like Wall Street type investments inside. Yes, that's correct, right? So Dave Ramsey's a shill for Wall Street. He's actually saying that a guaranteed asset, like an annuity, like the ones my mom has, those are terrible. But if he was ever going to recommend one of these annuities that was, out there, it would be the one that's not guaranteed, that has Wall Street type investments inside. Shill for Wall Street, okay? Unbelievable. And then he finishes with this. He finished this call, talk to one of our, Smart Vestor pros. Smart Vestors. Smart Vestors. What is a Smart Vestor? Why is Dave Ramsey recommending a Smart Vestor? Oh, this is the new name for his endorsed local providers. By the way, it costs nearly $1,000 a month to be one of Dave Ramsey's recommended Smart Vestor pros. People that he recommends that you should talk to one of his investment people, right? These are people that pay $1,000 a month, let's say, to be part of Dave Ramsey's network of referrals that he gives out, right? He makes a ton of money as, having this stable of Smart Vestor pros who agree to basically, this is the thing, you have to come in and basically agree to toe the line with Dave Ramsey. So Dave Ramsey, if you're not toeing the line with Dave Ramsey as far as the advice you give and how you work with clients, you can't be a Smart Vestor pro. Like, I'm pretty sure that Dave Ramsey's team would not let me pay him $1,000 a month to be a Smart Vestor pro. Pretty sure they would say no to having me as one of their endorsed local providers. All right. Whew. Now, folks, I've got to finish up the Watch Your Step segment with just tying it together. Pay attention to the motivations behind the advice you might be given. Okay? Pay attention to the motivations. And that goes for me and any other financial planner you might meet with, right? So I want you to consider this. An advisor who has an investment bias will generally only look at investment-related solutions. An annuity-biased advisor will look at annuity solutions. An insurance-biased advisor will focus on insurance, right? It's normal. We all have biases. Pay attention, though. So I spoke with a 78-year-old CEO this week who heard me speak at a business forum in a group setting, and he had asked to talk to me on a personal level. This gentleman is still working every day at 78 years old, largely due to a bad business deal with a partner that left him in debt and scrapping to rebuild his company. He finally has gotten to the point where he might have the opportunity to actually sell that business for a profit and retire on the eve of his wife's 80th birthday. Hear me, folks. 78 years old and he's working because he has to, right? On the eve of his wife's 80th birthday, they really might be able to actually get this thing sold. He's concerned, though, about losing a large amount of the sale proceeds to capital gains taxes. The business, when he took it over, came out of a bankruptcy situation, so it had a very low value when he took it over. Now he's looking to sell it for a pretty darn good price, and that's going to create a large amount of taxes here in the wonderful state of California and federal, etc. And one of the areas that, this is before he met with me, one of the things that had come up that had been recommended by a friend and then an introduction to another advisor was maybe we could give the business away to a charitable entity, like a charitable trust, and then the charitable trust would sell the business and not pay any capital gains taxes, and then the charitable trust would pay Mr. and Mrs. income for the rest of their lives. And it sounded like that could work. Well, the advisor they talked to eventually came back and told them that his plan was not right for them due to their age. Now, that did not sound right to me. That sounded wrong because certain types of charitable gift planning are more advantageous the older you are, because the income that the charitable arrangement pays back to the donor is based on mortality. It's based on age. So I researched this advisor a bit more, and I asked some more questions of the CEO I was chatting with, and it turns out that there was a life insurance component of the plan that the advisor wanted to do. And this 78-year-old and now nearly 80-year-old couple, they did not qualify for life insurance, and that's the real reason the advisor stopped. They don't qualify for the life insurance, so the plan that the advisor wants to do was really not viable. So he did not pursue it. Now, I, on the other hand, I'm a huge fan of life insurance. If you know me at all, if you've heard this show, I am a big fan of life insurance for family protection, but also cash value, dividend paying whole life insurance. I'm one of those very few financial planners who's really, truly an expert at it. I love it. It's not the answer to everything, though, right? So I, on the other hand, I'm not a life insurance or investment or annuity only advisor. I work with a fantastic law firm, for example, and I remembered that there is another option that we could look into that does not rely on life insurance as a key component of the charitable gifting strategy. And it could really make it all work very well for this couple and their daughter and their grandchildren. So pay attention, folks. Pay attention to the bias, right? We all have them, but in this case, this gentleman, had he not met me, that I have my own biases. However, I look at things in a very comprehensive way, and I'm not going to look past something else because I'm only going to focus on this one biased item. I'm going to look at everything I possibly can because that's the kind of financial planner I am, right? But pay attention to the bias in the advice that you might be receiving, right? Just a quick reminder, freeze your credit. Data breaches happening all the time. If you need help with your credit freeze, I'll send you the links to all the credit bureaus directly. I actually put them together in an email for a listener just last week. Please send me an email, Kraig@kraigstrom.com, and I'm happy to send you back a link with all three credit bureaus. You can freeze your credit. And for those of you wondering, thawing your credit is easy. I need to thaw my credit today for an insurance policy review for my business, and it'll cost $10. I'm happy to do it, and it'll freeze right back up again 24 hours later. So freeze your credit, folks. That's your best protection, okay? Your absolute best protection. Now, I want to finish with this, okay? This week, I want to talk about protecting the castle. Okay, so I talked to a friend of mine who is a commercial insurance broker. Commercial insurance, they insure all your business assets, your car, the cars and trucks and the buildings and warehouses and all of the people inside those warehouses that work. That's the commercial insurance. And we were commiserating with each other about the tendency that people have often to adding and increasing insurance protection. They have this tendency to avoid, right, adding or increasing insurance protection. My gripe was with a prospective client who wanted life insurance from me, life insurance for his family, and asked me how much they should get, and I explained the details behind my recommendation and that the life insurance in their case was first about replacing income if he died, right? So people should have enough life insurance to replace the ATM machine. That's the paycheck, the guy or gal who's earning the income, right? If somebody dies. For this guy, the amount of life insurance was about $3 million. $3 million would replace a lot of income for years and allow his wife to stay home with the kids long enough to get them grown up so that they were a bit more independent. He said, no way. No, that's way too much. $3 million, that's way too much. Just give me $1 million. Give me $1 million. And I explained that based on the current expenses with 2 kids, and his wife would have to either stay home or hire full-time childcare, $3 million was the number. $1 million would not last long enough. It would not pay the mortgage. It would not last long enough. He still said, no, she'll be okay with $1 million. By the way, the premium difference, the amount of money that he would have to spend for $3 million versus $1 million really wasn't that big a deal. Okay? No amount of emotional or fact-based arguments would change his mind. Okay? It just blows me away. Come on. You're protecting your children. You put them in car seats. You make them wear their seatbelts. We put kids in helmets to ride our bikes nowadays. We worry about what kind of fatty foods they're eating, and you won't buy extra life insurance to protect your children in the event you die? I'm sorry. That I do have a personal issue with that. I have a complete issue with that. I tend to lose some respect for people who won't go that extra $50 or $100 a month to add the necessary and correct amount of just protection in general for their family. That does bug me. Okay, I will tell you right now, flat out, it bothers me. I think it's, and maybe this is just the my dad coming through that whole 1940s, kind of style. I think it is a husband's and mother's responsibility to get the correct amount of life insurance. And none of this, they're okay with $1 million. No, they're not. I'll tell you right now, I do not want to deliver $1 million check to a family like that. If dad died and I had to sit down and deliver the $1 million check instead of $3 million, wow. I'm going to have to give some really bad news in the weeks and months ahead about how mom and her 2 kids are going to have to change their life to deal with things because $1 million is not enough, right? I'm going to get them the $1 million of life insurance, but I'm not happy about it. Anyway, that's my rant on that. But now, remember, I was actually talking to a friend of mine about this who's in the commercial insurance space, and he says, oh, no, I got you beat. He says, my biggest client, she lives in Beverly Hills, California, and we handle, he says, my friend is Blake, and Blake handles all of her personal and business insurance. Now, she has a $40 million home in Pacific Palisades, this big giant house, and she recently purchased a top floor high-rise condo in South Florida. Now, recently it's been a couple years, but Blake tells this story because it's so amazing. He says, this is a top floor condo, $5 million for a condo, right? Just your basic vacation place. But inside the condo, she has $11 million worth of artwork, paintings, statues, collectibles, rare antiquities, etc., etc. And Blake, during their policy review, suggested that she should add flood and wind damage insurance endorsements to the insurance package. This property's in the south of Florida. Hello. So Blake is super smart. I mean, he is protection focused and said, add flood and wind damage. You got too much to protect. The client refused, said, nah, the condo's on the top floor, so flood, no, we're never going to have a flood. And she also said, we just purchased very expensive storm shutters, so wind is not an issue. We got it covered. And of course, you guessed it. 2 huge hurricanes wreaked havoc on the Florida coast, and her condo was the only one that the storm shutters failed, completely failed, blew into the condo. Wind driving, rain pouring into the condo, right? driving gale force winds and an $11 million art collection and water pouring into the condo through the one open window in the building destroyed millions of dollars in artwork and furnishings. The client called and said, "What do we do, Blake?" Blake said, "Nothing but sue the installer and manufacturer of the storm shutters. That's about it. Your insurance doesn't cover flood and it doesn't cover wind damage because it wasn't on your policy." By the way, how much did that extra coverage cost? $3,700 a year. You heard it. $3,700 a year. That's probably one expensive dinner in Beverly Hills, right? One expensive dinner in Beverly Hills. This lady lives in a $40 million house here in California, a $5 million condo with $11 million in nice artwork, and didn't spend $3,700. The moral of this final rant of the day: don't scrimp on protection, right? Most people wear seatbelts. Most people wear helmets when riding a motorcycle. Most people put their children in a car seat when they're young, right? Most people look both ways before crossing the street. Stuff happens. Adding the right amount of protection is usually less expensive than eating out at a nice restaurant frequently throughout the year. Please don't scrimp on protection. Now, that's going to wrap it up for today. I got to go take a blood pressure pill, maybe calm down a little bit. Please check out my Freeway series. You can find videos on LinkedIn and on my Facebook page. It's actually an indeterminate length series of videos that I shoot from the road here in California traffic. And please, if you want to check out your personal journey to retirement and retirement income, please send me an email, Kraig with a K at kraigstrom.com. That's going to wrap it up. I'll talk to you next time soon.
Thank you for listening to the Personal Pension Radio Podcast. If you missed anything during the show, that's okay. We took the notes for you. Check the show notes for links, offers, and a full transcript. And don't forget to head over to personalpensionradio.com and download your free retirement income report. While you are there, we would appreciate some iTunes love. Please leave us a fantastic rating on iTunes by going to personalpensionradio.com/iTunes. Thanks again for listening.
Now for the disclosure. Information presented is for educational purposes only and is not intended for solicitation, sale or purchase of any security or financial product. Be sure to first consult with a qualified financial advisor and your tax professional before implementing any strategy discussed here. The term personal pension refers to a marketing name designed to educate future retirees and retirees about the economic principles behind creating their own pension-like income. The term personal pension is not intended to be confused with a defined benefit pension plan offered by an employer or by a government entity.